Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Today we are going to be exploring the beginning concepts of accounting. As we get started, I would like to, in the classroom, show you how to access the PowerPoint presentation that we're about to explore and also to discuss what is due for this week. So when you're inside Blackboard, in Principles of Accounting 1, the course is laid out like this. All of your course content is right there on the home page for you under course content. To access week 1, select module 1, week 1, and you'll begin here. The first area to look at is this first document. This is chapter 1. As you open that up, it'll have learning objectives and a couple of very short videos, just to help you to reinforce those concepts. Uh, so feel free to take a look at that. Just underneath there is the PowerPoint for this. So just go ahead and click on that, and it will automatically download to your device, and then you'll be able to explore it from there. And for this chapter, you will have a chapter 1 quiz that consists of 10 questions. It's a mix of true, false, multiple choice. My recommendation before you start the chapter 1 quiz would be to, of course, open your textbook to chapter 1, open the PowerPoint presentation, and read through and try the practice problems in chapter 1 before attempting the chapter 1 quiz. The chapter 1 quiz can be attempted up to 2 times. So what that means is, after your first attempt, if you missed any questions, or you simply want to try to earn a higher grade, you can take the chapter 1 quiz again. The higher of the 2 grades will be accepted into the gradebook. And the same is for the chapter 2 homework assignment. So let's go ahead and jump into chapter 1. Principles of accounting. What is accounting? Let's explore the accounting concepts. So, before we jump into this, can anyone tell me what do you think accounting is? It's defined as the language of business, but what does that mean? I mean, what is accounting? Why would somebody want to study this stuff? Anyone, any thoughts? What is accounting?
Accounting the numbers of a business, the ins and out of the money they spend, gain and lose.
That's right. That's right. Yeah, it's a record of transactions, money coming in and out of the business. Who else? Who else wants to add to that?
Uh, I say it's the foundation of any business when it comes to the monetary aspect of it, of whatever they're trying to do within their business.
Yeah, absolutely. Yeah, totally agree with that.
I say accounting is like a financial transaction for businesses.
Alexis, yeah, absolutely. Yeah, that's 100% right. What?
Professor, can it be other material objects like resources within your business as well?
Yeah, Zach. Yeah, absolutely. And that's also a major component of it. It's tracking resources. And we'll talk a lot about that as well. Excellent points.
And also keeping records of your transactions, keeping
100% right.
accounts of them, you know.
Yeah, most definitely. Those are all excellent responses. Uh, so accounting is just that. It's a couple of different things. We call it the language of business because it represents all of the economic transactions within the business that formulate the accounting statements. And we learn the language of business through understanding the financial statements. And we'll talk a lot about those concepts. So this first slide outlines what we're going to cover in the chapter. And the first question that I posed to you was, what is accounting? Accounting is the language of business, and it is a record of all economic transactions within a business. But why is accounting important? And there's a couple of reasons why accounting would be important. It's for managers, business owners, stakeholders to understand how financial transactions are recorded within the business, why they're recorded, what they measure, and how they are communicated. That's why accounting is important. Accounting is not just the preparation of financial statements for the business owners and managers to use. The information is also prepared for the government. Some of you had mentioned, oh, you're interested in taxation. Taxation, as you know, is what individuals and businesses pay to the government for the government to be able to provide services to its citizens. That is one factor of why accounting is important, because taxes are paid based off of the accounting records. There's so many other reasons, but this is why accounting is important. We identify, record, and communicate. What about uses? Accounting is the language of business. Because we're communicating data to our stakeholders for them to better understand the economic transactions that have happened within the business. There are two types of users. There are internal users and external users. External users are individuals outside of the company. Okay? External, outside. They're outside of the company. Those would include people like lenders, auditors, shareholders, the board of directors, regulators, and customers. There's a few more. There's a bunch more. The government should be on that list. Outside the company. These are all, anyone who is interested in the financial data being reported would be considered an external user if they're outside of the company. And there's a lot of reasons why these external users are interested in that data. Lenders need to know the financial statements to evaluate their credit worthiness. If the company already has too much liabilities on their balance sheet, there is a high likelihood that they would not be eligible for additional loans, so forth and so on, right? Shareholders are interested in the company's financial performance for investment reasons. I don't invest in companies that don't perform well, right? The regulators are interested from a taxation perspective. Customers are interested because the financial performance tells customers how well the company is responding to customers' needs. There's a lot of different reasons, right? Internal users are users inside the company. These are all the different managers, the owners, the other individuals that are inside the company, the employees. We get R&D, purchasing, human resources, marketing, production, distribution. These are all individual managers interested in financial statements inside the company. Additionally, you can include owners, other employees. The reason why an employee would be interested in financial statements of their company is because they want to understand how well their company is performing. I don't like to work for companies who are not performing financially stable, because that could ultimately say to an employee the future, the longevity of the company, right? And so when you hear external, think outside the company. Internal, inside the company. they're also interested in different types of reports, okay? External users are focusing on what we call public financial statements. Public financial statements. Public financial statements include audited income statement, balance sheet, statement of cash flows, statement of retained earnings. These are financial statements that are generated through accounting. External users get access to that information. Internal users are more interested in internal financial reports, like the budget, the cost of goods sold statement, the cost of production statement, the anything internal statement. So the way to think about it is external users see the public information, internal users see the company internal information. We'll break it down a little bit further. What are the type of roles in accounting? There's a lot of different roles. There's financial accounting, managerial accounting, tax.
Hello, Professor. I'm sorry to cut you.
Oh,
I
well.
have a question on the other side.
Yes, please.
Yeah, so I don't understand why shareholders and the board of directors are external users. Are they not part of the company? Are they outside the company?
They are outside of the company. Shareholders do not work for the company. The board of directors also does not work for the company. The board of directors are external individuals who elect a CEO to run the company. The CEO is not a part of the board of directors. They're internal. The board of directors are all external members that do not work for the company. So anyone who does not work for the company is considered external. Does that help to answer your question?
Oh, okay, I see. Thank you.
You're welcome. My pleasure. Good question. So within accounting, there's a lot of different roles. There's a lot of different opportunities. We have financial accounting, managerial accounting, taxation, and accounting related. That's cute. There is Principles of Accounting 1, which is the course that you all are in right now, focuses on financial accounting. This course, you will learn a lot about how to prepare financial statements of the income statement, balance sheet, statement of cash flows, statement of retained earnings. You'll learn how to analyze financial statements. You'll understand how external auditing works, how regulations impact financial statements, consulting, planning, investigation. Those are all components of financial accounting. Managerial accounting, which is Principles of Accounting 2, focuses more on cost accounting, budgeting, internal auditing, controllership, treasurer, strategy. These are all parts of managerial accounting. And there we focus more on internal financial reports. Taxation, relatively straightforward. Planning, regulatory, investigations, consulting, enforcement, legal services, estate plans. These are all related to taxation within accounting. And then we also have accounting related. Accounting related, these are all external services for accounting. Lenders, consultants, analysts, so forth and so on. It's a long, long list. Pretty much everyone else. That's what accounting is, basis. This is a nice objective. Why is ethics important to accounting? Okay, let me give you some background. The Sarbanes-Oxley Act of 2002. Sarbanes-Oxley Act of 2002. This was an act designed by the Congress of the United States at the time, based off of several accounting scandals that have happened in the past. A scandal is a deception. Right? What happened was there was a couple of large firms, Enron, for example, Health South. There's so many other ones. But those are like the larger ones that have happened in the mid to late 90s. In the mid to late 1990s, there was a large amount of deception happening within accounting. What happened is these firms, these companies, were overstating their sales. Overstatement means they reported sales that didn't actually happen. Okay? That's illegal, but it's also unethical to overstate your sales. The reason why these companies did that was to attract new investors, attract new stockholders. They would invest in the company based off of these reported sales that didn't actually happen. That's deception. That's illegal. And that raises a lot of ethical concerns. So, Sarbanes-Oxley Act of 2002 was created to provide investors with transparency across accounting statements for publicly traded companies. And what that did is it identified ethical concerns that translated into considering consequences for companies that violate those standards. And it provided framework for companies to develop ethical decision making based off of potential consequences. I can never say. Ethics is the foundation of everything in accounting now. It is critical that publicly traded companies are honest, transparent, and ethical with their financial reporting. And all that is to protect their investors. That was the purpose behind the Sarbanes-Oxley Act of 2002. Directly related, and one of you mentioned you're interested in going into forensic accounting. Forensic accounting has a lot to do with fraud. Fraud is the deception. Fraud is a deception, right? Fraud is committed for financial gain. That's why people commit fraud, financial gain. Companies sometimes will commit fraud to increase their overall sales, to increase their investment, for some financial gain. That's why individuals and companies commit fraud. And it's important to understand how fraud is committed and to find ways to limit fraud or eliminate fraud, and to really understand the whole conceptual framework behind why fraud is committed. This is what we call a fraud triangle. It identifies opportunity, rationalization, and financial pressures as to why fraud is committed. And the Sarbanes-Oxley Act, which is what I was talking about earlier, was developed to prevent fraud and also to ensure to the public, the investors, that what the companies are reporting are accurate, true, honest, transparent. What this act also did is it laid the framework for all publicly traded companies to be audited by an independent public accounting firm. In the United States, we have what we call the Big Four accounting firms. There were 5, there's no 4. There will be 5 again. We have KPMG. We have PricewaterhouseCoopers. Those are probably the largest 2 out of the 4. We have, who can help me? Who are the other 2? What are the other big two? You know? KPMG, PricewaterhouseCoopers. There's two other ones I'm missing. Those are the two that come off the top of my head. But the point is that there's these independent accounting firms that independently audit the financial statements of publicly traded companies. And it's important that that happens because it validates that what the publicly traded companies are reporting are accurate and true. Audit simply means is that the public accounting firm goes in and examines the accounting practices, the financial statements, and they audit it. They validate that what is in there is accurate and true. And the Sarbanes-Oxley Act helped to design that framework. So later on in life, 2008-ish, Dodd-Frank Act, 2008, 2009, shortly after the financial collapse from that time period, there were some additional provisions that the Congress put into play called the Dodd-Frank Act. And what this did is it gave provisions where banks had to have additional funds on their books in order to prevent a financial collapse. It gave more standards to that. It also provided mandated recovery in the event of fraud. It also provided protections for whistleblowers. A lot of good things came out of it. It's good to know. It's not critical, but it's important to understand the background. Okay, very important. We're going to let's start jumping into the real concepts of accounting. The generally accepted accounting principles. Generally accepted accounting principles are principles that govern accounting practice. Okay, these principles identify what we need to satisfy in accounting. Generally accepted accounting principles is well utilized here in the United States and several other countries throughout the modern world. And these generally accepted accounting principles govern accounting. They help to make things relevant and reliable. The idea behind it is it provides relevancy, reliability, and comparability. Relevancy meaning the financial statements that have been generated are relevant to decision making. Reliability means that it is honest, true, transparent, and could be tested for reliability. And comparability means I can take this company's information and compare it to another organization. For those of you in the hotel business, let's say you're with Marriott. You would take Marriott's financial statements and compare it to Hyatt. What that comparability does is it shows that there's consistency in reporting. Consistency. That's what makes things comparable. There is a lot of interesting things happening around the world today in accounting. There's this thing called a convergence happening. There are the BRIC companies, BRIC countries that use different standards. BRIC is Brazil, Russia, I forgot who I was, China, and there's a few other countries that are associated with it, but there are a few countries that were using different sets of standards in their financial reporting. And the rest of the world used a different set of standards. Today, those two standards are coming together, which is good because the world is shrinking. The world is shrinking. Have you heard that before? The world is shrinking. It's not physically shrinking. It's philosophically shrinking. Whereas we no longer have borders when we do business. Okay, I can sell something from the United States to another country, or another country can sell to the United States, and I can purchase it. That whole notion creates a different set of standards when it comes to reporting. Countries around the world are now getting onto the same page, and I can compare my company's performance to the performance of another company in another country through the standardization of reporting. So we have the International Accounting Standards Board, and we have the International Accounting Reporting Standards. And all of this has come together over time. It creates a sense of standard, right, around the world. And that's what's happening today. It's been happening for the past 10 years. And I think eventually they'll get there, but they're still hammering out a couple of details. Again, the whole idea behind it is to make things comparable. But more importantly, in this class, we're going to focus more on generally accepted accounting principles because that is what's utilized here in the United States. And we will discuss things like constraints, assumptions, and of course the principles themselves. There are four principles, well, that we'll focus on, but there's about 7 principles that we will discuss. So here are the 4 principles that we'll focus deeply on this class. First one is called the measurement principle, also known as the cost principle. And this tells us that there is a cost associated with each activity of the business. Cost associated with each activity of the business. There's always a cost associated. And this information is based off of actual cost. Actual cost could be something like an hourly wage. That's an actual cost. A cost of raw materials, work in process, finished goods, actual cost. The second principle that we'll focus on is called the revenue recognition principle. This is when we recognize revenue. Okay, when we recognize it. Okay, it's important for you to understand this because there are different types of businesses out there. We have service businesses and we have retailers and manufacturers. The revenue recognition principle applies to these different types of businesses separately. Okay, here's how it works. For a service business, let's say we own a lawn care service. I mow lawns. Okay, let's say I mow lawns. That's my business. And I charge a customer $400 for the month. Okay, the customer decided to pay me at the beginning of the month before I performed the service. Now, I cannot recognize that as revenue until I perform the service. Otherwise, it's just a liability to the company. And we'll go into more detail on that in a little bit, but the idea behind it is that I can't recognize the revenue until it's earned. Nassim, you have a question. Is actual cost the cost to produce the product or the market cost? The actual cost is the cost to produce the product. That's different than market cost. The actual cost to manufacture is cost. Market cost is what the market dictates the price to be, which is very different than the cost of production. Excellent question. With respect to revenue recognition, I cannot recognize revenue until it's earned. Something is earned when the service is performed or the goods are delivered to the customer. So for example, another example, let's say you buy something on Amazon. Okay? You purchase something on Amazon and Amazon says, hey, you'll receive your product in 2 days. Okay, that's cute. I like that. That's nice. So the seller on Amazon cannot recognize that as an actual sale until you have received that product. Yeah, that's called revenue recognition. You recognize revenue at the time the service is performed or the good is received by the customer. That's the only time we can recognize it as a sale. If we receive cash or payment before the service is performed or the good is delivered, then that is what we call a liability to the company. It becomes an asset when we recognize the revenue. And we'll talk more about that. That's revenue recognition. Next one is expense recognition principle, also known as the matching principle. This is when we record the expense when it's incurred to generate the revenue reported. What is it? Let's say I received my electric bill yesterday. Okay, I received my electric bill yesterday. The electric bill was for the electric I consumed during the month of July, but I received the bill in the middle of August. Okay. I would record the electric expense for the month of July, not for August. I record the expense when it was incurred, when it actually happened, not when I received the bill. Does it make sense? Any questions so far? We're doing all right. We're okay? All right. I know sometimes it gets a little bit dull, but don't worry, we're going to jump into some examples.
So far, so good.
Awesome, thank you, Andrew.
I have one question.
Go ahead,
So
Andrew.
for the expense recognition principle, I think it just depends on the company, how they actually record their monthly closing items. For me, we don't do like any, like, if, for example, we get a bill in August, but it was actually a July item, we actually incur it in July. So we do put it in the books for July, but we don't do any splitting when it comes to the cost itself.
Sure, and that's normal. Yeah, that's a very common practice. You're absolutely right. So sometimes, and Marina, I think what you're getting at is, let's say you received the bill in August, but it covers mostly July, but some August.
Yeah.
Yeah. So in that case, and you're correct by doing that, is you would allocate that expense for July if the majority of the cost was incurred in the month of July. Yeah, good, great question. Excellent point. Yeah, that's 100% right. That is a part of the matching principle. The fourth principle is called the full disclosure principle, and this is the notes that are attached to financial statements. We're not going to get too deep into full disclosure principle, but it's important to understand it. Okay, let's talk about assumptions. This is more principles, right? But let's talk about assumptions. We assume things in business. There are 4 assumptions that we make in business. We have what's called the going concern, monetary unit, business entity, and time period. Going concern. Going concern means, will the business continue to operate instead of being closed or sold? That's the assumption is the business will always continue until it's either closed or sold. That's the assumption. Monetary unit is what monetary unit is being used for that business? Is it the US dollar, the British pound, the euro, the whatever? Business entity. What type of business is it? Is it a sole proprietor, LLC, S Corp, C Corp? And what's the time period? That's the life of the company that can be divided into months and years. In accounting, when we talk about time, we talk about accounting periods. An accounting period could either be a month, a year, a quarter, half a year, or a full year. A month, a quarter, half a year, or a year. Those are the accounting periods. Most of the time when we talk about accounting period, we'll either identify it as being an individual month or a full year. We'll talk more about that. Different types of business. We have a sole proprietorship, partnership, corporation, LLC, S Corp, C Corp. Sole proprietorship, one owner. Partnership, two or more owners, called partners. Corporation, S Corp, C Corp. S Corp stockholder, C Corp stockholder. Slight difference. And limited liability company. My company, when I owned mine, was an LLC. LLC, what it does, and this is probably the most commonly formed business in the United States right now, is an LLC. And most of you probably know that over 85% of all businesses in the United States are classified as a small business and are typically LLCs. The limited liability means is that if the company gets sued, they won't go after your personal assets. They will only go after the assets owned by the company. It almost treats them as being separate from the person, which is really nice. Sole proprietorship, you are the business. There is no separation. LLC, the business is its own person. Partnerships, two or more individuals, they usually identify a percentage of ownership based off of the amount that each partner brings into the business. And with corporations, it's usually set up as by shares of stock that represent ownership within the business. This is just a nice representation of those different types and the different classifications, things like that. Constraints, more principles, right? Constraints. There's a cost-benefit constraint and a materiality constraint. Cost-benefit, where the benefits of disclosure greater than the cost needed to be disclosed. Cost-benefit. Materiality. If someone is reasonable and there's a reason to disclose, we call it materiality. These are all notes that are attached to the financial statement. I'm not going to go too deep. Okay, now let's really get into it. This is the meat and potatoes of this whole chapter. Okay, this is the foundation of everything accounting right here, and we're gonna cover this in 15 minutes. Ready? Or less. The accounting equation. This is it. This is accounting right here. This is the foundation of accounting. We call this the accounting equation. Okay? Assets equals liabilities plus equity. Assets equals liabilities plus equity. This is the accounting equation. This is the foundation of everything we do in accounting. Okay? I'm going to break down each part for you. Assets. Assets are what the company owns. Assets are what the company owns. Owns. Things of ownership. Assets is ownership. Assets are what the company owns. Okay? That would include things like cash, accounts receivable, property, plant, and equipment, Those are all examples of assets. Cash, accounts
Professor, I have
receivable,
a question.
property, plant, and equipment. Yes, go ahead, Meredith.
When you're referencing ownership, if company property, if there are vehicles in the company and they're being financed, not leased,
Lease,
is that considered
finance,
ownership?
yeah, it's still an asset, even if it's financed. But
Okay.
there's a difference in what's owned and what's financed, right? So it would be an asset, but it would also be partly liability.
Okay.
And
Thank you.
we'll talk about that here in a second. Great question. Awesome question. Yes, so assets are what the company owns. Cash, accounts receivable, property, plant, and equipment. Within equipment, you can also identify things like automobiles. Equipment, that's wide ranging. Cash, accounts receivable, property, plant, equipment. Those are all assets, what the company owns. Equals liabilities. Liabilities are anything that the company owes. O-W-E-S, owes. A liability. A liability is when the company owes something to someone else. Okay? Liability. Liability. Something the company owes to someone else. There's a lot of examples of liabilities. Here we go. Accounts payable. Accounts payable. Those are bills that the company received, have not yet paid them. Accounts payable. Accounts payable. Wages payable. The employee worked for the company for 2 weeks. I have not yet paid them. That's not wages payable. Taxes payable. I owe the government agencies taxes. That's what taxes payable. Those are all what we call current liabilities. When you hear the word current in accounting, it means within 12 months or less. Current, 12 months or less. Long term, greater than 12 months. 12 months or less, current. Long term, greater than 12 months. Current liabilities are accounts payable, wages payable, taxes payable, pretty much anything, most things payable. Long-term liabilities would include things like a mortgage, a car loan, auto loan. They're long-term, greater than 12 months.
What about student loans?
Student loan, yeah, that's a long-term liability for most of us, including myself. Yeah, great example. Most definitely, long-term liability. So when you hear liabilities, anything the company owes to someone else. And then we have this thing called equity. Okay, equity gets a little bit more complex. Equity is what the owners of the company own. I like that. What the owners of the company own, equity. It's the difference between assets and liabilities is equity. Another way to write the accounting equation would be assets minus liabilities equals equity. That's another way to write the accounting equation. But I'm not going to confuse you too much. Go ahead, Jen.
Like stockholders?
Stockholders, yeah, that would be under equity, absolutely. So the way that equity works is we have what the owners own, which would include, the stockholders, the individual partners, the owners of the company. Right? What the owners own minus owner withdrawals. A withdrawal is when the owners receive a distribution, a cash distribution from the company. They're paying themselves. That's a withdrawal. Plus revenues minus expenses. So equity is what the owners own minus withdrawals plus revenue minus expenses. Now, you see revenue and expenses there under equity. Revenue minus expenses equals net income. That's on the income statement. I'll show you what that looks like here shortly. But when you see revenue and expenses under equity, The reason why it shows under equity is at the end of each accounting cycle, at the end of the year, we do this thing called closing the books through the closing process. And what happens is we need to, at the end of the accounting period, we need to close out our income statement to get it to be zero for the next accounting period, because they're what we call temporary accounts. And what we do is we close it out to equity. And we'll talk more about it, but I just want you to kind of understand why revenue and expenses shows under equity. And every transaction that the business experiences will affect two different accounts. And I'll show you what those examples look like. So revenue minus expenses equals net income, and that's under equity. Transactions. This is the crux of everything we're going to talk about in this course. Every business transaction impacts two accounts, and these accounts impact the accounting equation. Remember, assets must always equal liabilities plus equity. The two must always be in balance. That's why we call it the balance sheet. Assets equals liabilities plus equity. That must always be true. There are many transactions in business, and with every transaction, there are two accounts affected. We call that double entry accounting, because there's two accounts in every transaction. Here's an example. First example. We have an investor. They invest $30,000 of cash into the business to start a new business. Okay? Now, when you are putting cash in the business, you debit cash to increase cash. Anytime that the business adds assets into the business, we debit the asset account. In this case, it's cash. The individual is putting cash into the business, so we debit cash to increase cash in the business. And since it's an investor, we would want to then credit an equity account. Debit cash to increase your assets, credit your equity to increase your equity. The accounting equation is still in balance. Assets equals liabilities plus equity. Let's take a look. We debit cash to increase cash. We credit capital account, equity, to increase our equity account. The accounting equation is still in balance. Let's look at the accounting equation. We debited cash to increase our cash by $30,000. We credited our equity account by $30,000. $30,000 equals $30,000. The accounting equation is still in balance. We did not do anything to liabilities because there was nothing to do to liabilities. So it would say 30,000 equals 0 plus 30,000. 30,000 is 30,000. Make sense? So far, so good, right? Awesome.
Yes.
Great, thank you.
Confirming cash can't just exist as cash. It has to go under and be regarded, categorized as equity. I'm asking a question, sorry. I'm not making a statement.
Okay, I'm just making sure. Okay, so Meredith, would you mind rephrasing your question?
So I said confirming cash received cannot just exist as cash. It has to be defined, and it has to be defined as equity. I'm asking.
It depends on the reason why you're receiving cash. So there's multiple reasons why we receive cash. Cash can be from an investor. In that case, it'll be equity. Cash could be we're receiving cash from a customer who's purchasing something from us. In that case, it would still be equity, but it would fall under net income, under equity. So the short answer is typically yes. Typically yes. There are some instances where it would not be, For example, if I sold a piece of equipment, land, or property, I would both increase and decrease my assets. And I probably wouldn't touch equity unless there's a difference between the two. So
So it depends on the source.
it depends on the source, exactly. Yep. Excellent question. There's some tricky times, but for the most part, I would say yes. But there are some instances where that is not true. Excellent, excellent.
Professor,
Yes, please.
I just want to make sure I understand the reason we are crediting the equity part. Is it because capital is under equity? That's where the money is coming from.
Yep, that's correct.
That's why we have to credit that account and then debit where it's going, right?
Not always. So look at the accounting equation. Anytime we increase assets, we debit the asset account. In this case, it's cash.
Okay.
To increase equity, we credit the equity account to increase the equity account. So think of it like the other side of the equal sign.
Mm-hmm.
Anytime there's the other side of the equal sign, one must be debit, one must be credit.
Mm-hmm.
And that's why. But yeah, the reason why it's capital is because the investor is putting money into the account, into the business, and so we need to represent that amount of ownership under capital. Good question.
So that means the equity account, I mean, it's going down.
It's going up. They're both going up.
And they're both going up?
Yep. Cash went up, equity goes up.
Oh, okay.
Remember, assets must always equal liabilities plus equity.
Oh.
Yep. Good question. Let's take a look at another example, another transaction. Our company purchased supplies. Sometimes the book refers to supplies. Supplies can either be inventory or office supplies, which are very different things. Sometimes the textbooks are not always clear with this, but my assumption is that this is probably inventory. Our company is purchasing inventory by paying $2,500 in cash. So there's two accounts. There's supplies and there's cash. Okay. I need to credit cash to reduce cash. Okay. You debit cash to increase cash. You credit cash to reduce cash. Anytime you credit an asset account, you're reducing the asset account. And I'm debiting my supplies. Okay, supplies, inventory, which is also an asset account. I'm increasing the supplies asset account. Here's how it looks on the accounting equation. Now, the second transaction. I debit supplies to increase supplies, and I credit cash to reduce my cash. There is a zero net change to the accounting equation from the second transaction. Why? Because I'm only affecting assets. I'm exchanging cash for supplies. I'm increasing supplies and I'm decreasing cash. We see that the amounts are the same, right? Therefore, there is a zero net change on the accounting equation. Let's see what, so they're not losses, they're decreases, but yes, negative signs, absolutely. We usually, in accounting, we use parentheses instead of a negative sign to represent the decrease of something. Good question. I know in mathematics, it's usually a negative sign, but in accounting, we use the parentheses, the brackets, whatever the hell you call those things, quotations on the brackets to represent a decrease. Good question. There are thousands and thousands of examples I can show you. Let's look at this third one. Our company is purchasing equipment for $26,000 using cash. Oh my goodness. We're going to get rid of all our cash. It's not a smart thing. When supply is lost, oh my goodness. If it's office supplies or used, if we consume it, we expense it out. No, we'll show you what that looks like later on. But yeah, we would expense it. We'll reduce it from our inventory, and we'll shift it to an expense on the income statement. I'll show you what that looks like. Okay, third example. Our company is purchasing $26,000 of equipment in use of cash. We debit equipment and we credit cash. Debit equipment, credit cash. So this the third transaction. We debit equipment to increase equipment. Equipment is an asset. We credit cash to reduce our cash. Cash is also an asset. Again, zero net change. This example. Another example, we purchase supplies on credit. I would use the word on account. In accounting, when you hear the term on account, it means you're purchasing it on credit from your vendor. You'll pay the bill later. Okay. There's a couple things that happen here. We'll debit our supplies because we're increasing our supplies, right? Our asset, our inventory. We're debiting inventory to increase inventory or supplies. Debit supplies to increase supplies. We're going to credit accounts payable. This is your first introduction to accounts payable. We're going to credit accounts payable. Accounts payable is an account that we use to represent bills that we have received but have not yet paid. Bills that we have received but not yet paid. That's called an accounts payable. We will pay that within 30 days, typically. So the impact on the accounting equation, the fourth transaction, we debit supplies to increase supplies. And we credit accounts payable, which is a liability account, to increase accounts payable. We see the accounting equation is still in balance, even after these four transactions.
Professor,
Oh, yes.
since it's a liability, why is it increasing? Why is it going up?
Because I purchased something on account. When I purchase something on account, I'm purchasing it on credit.
Okay.
I need to pay that back. That's why it's a liability.
Yeah, what I mean is, why isn't it negative? Why doesn't it have like the parentheses?
Because it's not negative. So when you increase a liability, it shows up as positive. When you decrease the liability, that's when it becomes you'll see the minus.
So basically, when you borrow money and it goes to your account, it goes up. It's an increase for you. But then when you pay it off, it's a decrease.
Exactly. That's exactly right. Yep. It works the same way with like a loan. Think of a student loan, okay? Student loan. Let's say maybe not a loan. Let's call it a. Let's say you bought a car. You bought a car. You financed the car. The car value is $25,000. You would debit equipment $25,000 for your car. and you would credit notes payable. Notes payable is a liability. It would increase the liability because you bought the car on credit. You bought it using your credit. And eventually your notes payable every month will go down a little bit.
Okay.
See what I'm saying? Okay.
Yeah, yeah.
Will go down a little bit. Exactly. Yeah.
Got it.
Great.
Thank you.
You're welcome. Excellent question. Okay. Let's take a look at revenues, expenses, and withdrawals. Fifth transaction. Provide services for cash. Provide services for cash. A customer is paying us cash to provide them with a service. So, in this example, we're providing consulting services to a customer. We received $4,200 in cash right away. I don't know if that means we have already performed it or not. Looks like we did. Okay, so we debit cash to increase cash, and we credit revenue to increase our revenue. Revenue is an equity account on the accounting equation. We debit cash, increase cash. We credit revenue to increase revenue. This is the fifth transaction. The accounting equation is still in balance. The more that you practice these types of transactions, the more you'll understand how accounting operates. I'm telling you, accounting is a practice. The more that you practice things, the more you'll understand them. Transactions 6 and 7. Payment of expense in cash. Okay, we got to pay for stuff now. All right, we got two transactions. We got to pay $1,000 for rent, and we owe an employee $700. We credit cash to reduce our cash. We debit rent expense to increase our rent expense. We credit cash to reduce our cash. We're also debiting salaries expense to increase our salaries expense. So when it comes to expenses, the way I want you to understand it is, as the expense is incurred and paid, as an expense is incurred, we increase the expense. As the expense is incurred, as it happens, we increase the expense. And we credit the form of payment, in this case, cash. Here's how those two transactions. Transaction 6 was rent. We credit cash, decrease cash, increase our expense, $1,000. And the same for the wages payable, or the wage expense. Sorry. But we see how, and what this does is it shows us the impact on the accounting equation, how everything remains in balance. Another transaction, provide services and facilities for credit. That's a weird one. Okay. We provide consulting services, and I guess we're renting a facility for credit, on credit, I should say on credit. Okay, when something is on credit, let's say we have a lawn service, or let's say we have a consulting service, and the customer comes to us, we perform the consulting service, we give them a bill, and we say, hey, pay us within 30 days. That creates what we call an accounts receivable. An account receivable. Here's how an account receivable works. You perform the good or the service, and you give the customer a bill. That generates what we call an account receivable. It means the customer will eventually pay us. We increase the account receivable by the amount of the good or the service for that customer. So we debit account receivable, which is an asset account. And we credit, in this case, consulting revenue and rent revenue. Revenue is the sales. Account receivable is when we sell something to our customer and we give them a bill. They haven't paid us yet. That's account receivable. And here's the impact on the debit account receivable to increase receivable. Credit revenue to increase revenue. Transaction 9. Our customer's paying us now. So a couple days later, maybe a month later, we got some customers that are paying us from receivables that we sent them. We sent them a bill for $1,900. They're paying us now. So remember, when the company receives cash, we debit cash to increase cash. And we're going to credit accounts receivable to reduce accounts receivable. Now, when we talk about accounts receivable and accounts payable, we call these contra flow accounts. Contra flow accounts. It means that accounts receivable and payables goes up and down, right? Contra flow. Contra flow. It means they go up and down depending on what happens, right? Other accounts some accounts go up and down, but accounts receivable goes up and down. Accounts receivable goes up when I issue the bill. It goes down when the customer pays the bill. Accounts payable goes up when the company receives the bill. It goes down when the company pays the bill. Contra flow account. So in this case, we're debiting cash to receive the cash from the customer, and we're crediting accounts payable, or I'm sorry, accounts receivable to reduce the receivable. Two asset accounts. Accounting carries and still in balance. Transaction 10. We're paying a bill. Company's paying a bill. We received the bill for $900. We're making a partial payment for supplies that we purchased back in transaction 4. So we debit, I'm sorry. Show up right now. Oh yeah, we're just paying the bill. Okay, we already recorded the supplies. That's right, from transaction 4. So in this case, we're going to debit accounts payable to reduce accounts payable and credit cash to reduce our cash. Debit accounts payable to reduce accounts payable, credit cash to reduce cash. We see the accounting equation still in that. Withdrawal of cash by owner. Owner's paying themselves $200 for whatever reason, taking cash out. So here's how it works. We
May I ask a quick question?
Yes, please go ahead.
Okay, so I'm trying to understand transaction 9 for a second.
Sure. Okay, go ahead.
Okay, so no, keep it there.
Yeah.
On the chart.
Sure. Oh, on the chart. Sure.
So it looked like when you're going from 8 to 9, that you basically move the money from accounts receivable to cash when someone paid the bill, correct?
That's correct. Yep. That's exactly what happened.
So we we deleted the amount accounts receivable because it's now received and now it's in cash.
That's
So
correct.
we still call a bill revenue, correct? Okay. Maybe you're going to get to this. Maybe I'm getting ahead of myself, but having known friends who are like construction, if I charge a company, I'm a construction company, and I charge the bill the domain services for my work, and they do not ever pay it, and we put a lien on the property, and let's say they never pay it, what happens?
So it remains in accounts receivable, if they had never paid it.
But I'm still putting it as revenue, correct?
Well, if you
To keep the
perform the
equation
service,
balanced.
yeah, well, so remember the revenue recognition principle. Once you perform the service, in this case, built the house, you classify it as revenue at that point. So it's still revenue, even if you didn't receive the cash payment for it. It's still revenue. But, you know, in the event that something like that happens, there's what we call a write-off process. And that's when we get more into taxation. That's way down the road. But yeah, that gets a little bit more complicated from that point.
Okay, because I'm just trying to understand it from a logical standpoint, that if I'm a company where I just build up revenue but don't build up cash, how can I stay afloat?
You wouldn't, yeah, but you should always be collecting cash from your customers based off of your sales. So there's two types of customers. There's a cash customer and there's an accounts receivable customer. The cash customer pays you cash at the time that the good or service is provided. The other type of customer, accounts receivable customer, those are the customers that you, the company, sent them a bill, and they will eventually pay you the cash that's owed. So, uh, in that case, you would reduce your accounts receivable and increase your cash when you receive that payment from the customer. The revenue's already been accounted for. It's two separate transactions, right?
Right, understood.
Yeah, cool.
I'm looking at it from a practicality side. I
Oh,
apologize.
no, it's fine. That's a great discussion. It's good to look at it from a practical perspective because that's how we apply accounting is through practicality. Excellent, excellent question. Okay. Yep. So anytime that there's a cash withdrawal, we debit withdrawal, which is an equity account, and credit cash, which is an asset account. And this is a summary of all the transactions that have happened 1 through 11 that we just worked through. And you can see that through all of the transactions, the accounting equation is always going to balance. Assets will always equals liabilities plus equity. Always, always, always. And yes, and Jenny accurately said debits will always equal credits. So in every single transaction that occurs, your debit amount will always equal your credit amount. Talk about the financial statements real quick. We have income statement, statement of owner's equity, balance sheet, and statement of cash flows. These are all separate financial statements. These financial statements are generated from the individual transactions that we just went through. So every single transaction generates these financial statements. So at the end of each month, I have a completed income statement. I have a balance sheet. I have a statement of owner's equity, and I have a statement of cash flows. So at the end of each month, these statements are generated based on the transactions that we just experienced. On the income statement, the income statement shows revenues and expenses over each period of time. Revenue minus expenses equals net income. That's on the income statement. On the statement of owner's equity, this represents changes in ownership. Changes in ownership as a result of withdrawals or deposits from owners. On the balance sheet shows how cash is being used within the business. And you can look at this at any point in time. The balance sheet shows operating activity, investing activity, and financing activity. We'll talk a little bit more about that here in a second. That's the statement of cash flows. And of course, the balance sheet shows assets, liabilities, and equity, the balances of those accounts. So at the very top, this is a very consolidated version of an income statement. You have revenues and expenses. Revenue minus expenses, total revenue minus total expenses equals net income. Net income shows up on your owner's equity at the end of the accounting cycle. Investments plus net income minus withdrawals equals the remaining capital. The remaining capital shows up under equity on the balance sheet. So you can see how all three financial statements flow together. The balance sheet flows into the statement of cash flows. How does that happen? We see that assets equals liabilities plus equity. 40,000 plus equals 40,000. The cash from the balance sheet, 4,800, is the ending cash balance on the statement of cash flows. The statement of cash flows represents the physical flow of cash within the business during the accounting period. Cash coming into and out of the business for operating activities. Operating activities are the day-to-day operations of the business. This would include revenue and expense activities. The investing activities is the purchase or sale of property, plant, and equipment. And financing activities represents the addition or subtraction of financing activities like investments, loans, or any type of other financing. And that's how the financial statements are formed. A couple of ratios. Ratios are used by businesses to understand their overall financial health, okay, of the company. And in accounting, we compute a couple of ratios to compare their performance over time and to compare their performance against competitors. And there's a couple of other reasons. The first ratio is called the return on assets. It's computed by net income divided by average total assets. Net income is found on the income statement. Assets are found on the balance sheet. Net income taken from your income statement divided by average total assets. Average, what is average? To find the average of pretty much anything in accounting, you take the beginning balance plus the ending balance divided by 2. Beginning balance plus ending balance divided by 2 will give you the average total assets, or the average of pretty much everything. That philosophy applies to find the average. And looking at the return on equity, it tells us a couple different things. It tells us, basically how our assets are being utilized. Our assets are being utilized. And that information tells us, this kind of shows you how everything flows within the business. So from operating, investing, financing, it's all from the statement of cash flows, planning. We do planning for all of this. It's just a nice graphical representation. It's not too meaningless, but it's on the statement on this statement of cash flows. We have investing activities. We have operating activities, investing activities, and financing activities. Investing activities is investment into the organization. That's purchase of property, plant, and equipment. Purchase or sale of property, plant, and equipment. Property, plant, and equipment, as you know, are assets. Financing activities could be owner financing or non-owner financing. Owner financing is the investment from owners, like either the capital, paid-in capital, or withdrawals. And non-owner financing would be from lenders, from banks. And operating activities at the top of the income statement shows us the use of cash from day-to-day operations. They'll include revenues and expenses related. Oh my goodness, we finally made it to the end of chapter 1. Holy smokes. Any comments, questions, concerns so far? It's like 10 minutes left in this class.
We'll be able to access the slideshow in the Blackboard, right?
That's correct. Yep, everything is in Blackboard. And this recording will also be posted there as well.
Okay, thank you.
You're so welcome. Any other comments, questions, or concerns?
Yeah, just a lot of information to take in.
It is, especially on the first day. Yeah, it's this is an 8-week course, so everything is very, very consolidated. There's a lot of stuff happening within a short 8 weeks. Okay, so this is the end of chapter 1. I know that we said we were going to try to get through chapter 2 today as well, but there are only 10 minutes left in class. So, having said that, what I'm thinking is we will probably have to host class on Thursday, which I know it's scheduled that way anyway. And in cases like this, since we did go a little bit over, I think it would be better for us to do chapter 2 on Thursday. What do you all think? Is that probably the best way to do it? Jenny says yes.
Yes, that works. Yeah.
Is that good for you?
Yeah, that's good.
Okay. All right, good. Sounds good. So what we'll do is we'll cover chapter 2 in that case on Thursday. Because I think it's really important that we do take our time a little bit with it, especially early on, so that way it gives you time to consume the information. And I really don't want to rush too much with it because it's a lot to consume at once. So what we'll do is we'll call it a day today, and on Thursday we'll explore chapter 2. And with that, as always, if you have any comments, questions, or concerns, you have my email address, my phone number. We can set up office hours, whatever it takes. I'm here for you 100% of the time. And as a reminder of what's going on this week, we just went through chapter 1. On Blackboard, module 1, week 1, we just went through chapter 1. Make sure that you complete your introductions. There's a chapter 1 quiz. You're more than welcome to take that now. There are 2 attempts on it. So whenever you're ready, it's there for you. To access the textbook, select textbook in the classroom, and then select Follett Red Shelf. Please read through the chapter, review the PowerPoint, review this video before attempting chapter 1 quiz. We will cover chapter 2 on Thursday. We'll go over the chapter 2 PowerPoint and then do both the chapter 1 quiz and the chapter 2 homework are both due on Sunday night. So please, my recommendation is to work early and often throughout the week for success.
Professor, do we have a video to watch on Blackboard?
This is the video. This class is the video. The video will be.
Oh, okay.
Good question. Any other comments, questions, or concerns?
Professor, just to make sure we all on the same page. So this Sunday we have chapter 1 and 2 quiz to complete,
That's,
along with Thursday we will be back on WebEx to go over chapter 2. Am I right?
that is correct.
All righty, thank you.
You're very welcome. Okay, y'all. Well, I appreciate your time today. As always, please stay safe, wash your hands, do the right things, and if you ever need help, I'm here for you. Thank you all so very much for your time. Appreciate all of you. I'm looking forward to a great semester.
Thank you,
Right.
Professor.
Thank you,
Bye.
Professor.
Have a great day.
Bye,
Take
everyone.
care.
Have a
Bye-bye.
great day.
See you.